How can you compare ETF expense ratios effectively? Imagine shopping for a new gadget. You look at the price tag but also consider features, warranty, and reviews. Comparing exchange-traded fund expense ratios is similar. It's not just about the percentage but what you get for that fee. The expense ratio shows the annual fee the fund manager charges to cover operating costs. It is expressed as a percentage of the fund's total assets. For example, a 1% expense ratio means you pay $1 yearly for every $100 invested. This fee directly cuts into your returns over time. But it is only part of the story. To compare ETFs properly, start by finding the expense ratio. You can find this in the fund's prospectus or on financial websites by searching the ETF's ticker symbol. Passive exchange-traded funds usually have lower expense ratios, often between 0.03% and 0.3%. Actively managed funds tend to be higher, sometimes between 0.5% and 1% or more. Next, compare similar ETFs. For example, compare large-cap index exchange-traded funds with each other. Comparing a large-cap index ETF to a bond ETF can be misleading because management costs and strategies differ. Then, think about the total cost of owning the ETF. The expense ratio is just one part. You should also consider trading costs like bid and ask spreads. These are the differences between the buying and selling prices. Narrow spreads cost less to trade, especially if you trade often. Also, check if your broker charges commissions. Many now offer commission-free trading, but some still do charge fees. Another factor is tracking error, which is how closely the ETF follows its underlying index. A low tracking error means the ETF performs similarly to the index it tracks. For traders or options investors who buy and sell frequently, bid and ask spreads and trading fees matter more than the expense ratio. For long-term investors, the expense ratio and tracking error are more important because they affect your overall returns over years. Use online tools or calculators that include all these costs. These tools can help you estimate the total expense of owning and trading the ETF over months or years. Finally, look beyond costs. Consider the ETF's liquidity, management quality, and how well it matches your investment goals. Sometimes a slightly higher expense ratio is worth it if the ETF has better liquidity and lower trading costs. For active traders, a fund with tight spreads and no trading fees can be cheaper overall than a lower-cost ETF with wide spreads. For buy-and-hold investors, the lowest expense ratio and minimal tracking error are best. To sum up, comparing exchange-traded fund expense ratios effectively means looking at all costs involved. Think about trading costs, liquidity, and how these factors fit your trading or investing style. This way, you can choose the best ETF for your needs and keep more of your money working for you.